Hello again. This is Josh Carr with The Real Angle, and today I'm speaking with Malcolm Frodsham, Director of Real Estate Strategies. Malcolm, how are you doing today?
Yes, good afternoon, Josh. Or good morning for you. Yeah, I'm doing well, thank you.
Close enough. Yeah, this is the blessing and the curse of doing an interview with someone who's not in the same time zone, which I think is probably a reasonable guess on the part of people listening, based just purely on the accents. So let's start with the basics. Where in the world are you today?
Yep, so we're based in London in the UK. So I'm currently down in Kent,
Excellent.
which is pretty miserable and glum, which is what we expect this time of year.
Yeah, sadly, not surprising. Not surprising
No,
for
not at all.
your neck of the woods. Definitely. So yeah, let's talk a little bit. So first off, one thing I always like to tell people right at the outset, because invariably, if I don't mention it, someone will email me. The company is Real Estate Strategies, and their web
Yep,
address
that's right.
is realestatestrategies.co.uk, which again would give a tip off that you're based in the UK. So. So let's start with the basics. Real estate strategies. What is real estate strategies? And you run the place. When did you start it? What's the background, if you will?
Well, we started back in 2013. Um, I mean, my background has always been in real estate research and particularly real estate data. So I'd sort of come out of industry roles doing research and strategy, and I'd always sort of thought, well, actually, the tools you actually use doing real estate research, I mean, they're not, it's not easy. It's not actually easy to actually influence decisions. So it'd be quite frustrating, basically sitting in the office and hear about deals that are happening and thinking, well, did I actually influence, did I actually influence that deal? How did that deal happen?
Now, where were you before real estate strategies? Because I think the
Yeah.
job of economic forecaster, if I could generalize, and I think you fall under that rubric. We see a lot of talking heads on television, and it's not really clear where these people came from. Like, what were you doing before you were running your own shop, if you will?
Yeah, yeah. I mean, it is interesting the history of sort of real estate research. I mean, I graduated all the way back in 1992 into the teeth of a pretty miserable recession, which had basically wiped out the real estate development industry here in the UK. So wasn't really a huge amount of recruitment going on, and I stumbled into this sort of obscure company that had the idea of collecting data on real estate markets. Um, Over time, that company grew. It was called Investment Property Data Bank, IPD. Um, and I was there for about 7 years before I sort of jumped ship and went into sort of the fund management world. And there were two companies. One was called Barclays Property Investment, and the other one was Legal and General Investment Management. And I was doing some great stuff. I mean, at Barclays, we were doing derivatives, which was fascinating.
Sure.
We were launching funds, so we were investing in residential property all across the UK and marketing that to investors all across Europe. Um, in Legal and General, we were setting strategies for unlisted funds again, for the life fund, for pension funds, trying to grow funds. So it was very interesting and very varied. It was always just that frustration of thinking, well, you know, did I actually influence? What did I
Right.
influence?
Right. You're reading data, you're generating data, and I mean not to beat up on the research arms too much, but I know at a lot of commercial brokerage firms, the research arms are used really as marketing tools more than anything else. And,
Yes.
and there's often a bias. I mean, it's rare that I've seen a research arm at a brokerage firm say, "Don't trade." Like they want to generate revenue, which I get, and that of course can infect the research process. But nonetheless, no, I hear you. I mean, I've done a little bit of consulting work in my own life, and you write a big fat report, and then you're not really clear if it achieved anything other than kill a tree. And
Oh yeah, I did. I did have one great boss who was a pretty tough guy, and he made it very clear that if I hadn't got across the main points in 3 bullet points, he really wasn't going to go any further than that. So big research reports. They yeah. I'm not entirely convinced. They often have much impact, and I think the way to think about research is, unless it is going to be used purely as marketing,
Right.
is that you've got to think about it as you are influencing a process, and the process is all about how this organization is actually doing what it does, which is usually managing other people's money.
Right.
And you want to influence that and make that as successful as possible, which does mean fees. I mean, they are fee earning organizations.
Right. Well, and
So
this brings me to the services and products you provide. So what are
yep.
the tools you're providing investors to, in theory, invest better?
Yeah, we have sort of two key products. One is our forecasting product, and the other is an asset allocation model. So
Okay.
forecasting we sort of regard as part of the asset allocation process. So you know, asset allocation as sort of distinct from stock selection is all about deciding, well, what sort of properties am I going to buy, and where am I going to buy them? How does that actually fit into a portfolio? And I think that's the best place for research to really influence assets that are actually eventually bought. Because if you don't influence it quite early on at the sort of portfolio strategy phase, really gets too late, because once the fund manager and the agent are together, that's it. You can't get between them. It's a
Right.
ferocious.
Once they're looking at the deal and they're bidding and money is being discussed, they're already eager to get the deal done. To hear at this point, well, retail's a bad idea. They're way past that conversation.
Yeah.
Um, that makes sense. That makes sense. I mean, it's kind of it's a crass example, but a colleague of mine, a guy I grew up with, his father came from a decent amount of money, and his father was concerned that his son would marry for love rather than other reasons. And he said to him once, and I'll always remember this, he said, "Son, I'm not telling you you should marry a rich woman. I am saying, though, you should only date rich women. This way, when you choose to marry,
Oh,
she'll
that's
be
brilliant.
rich." Which which I thought was a wonderful way of putting it, and I think about what you're saying.
I love
It's
that.
it's similar. I let's first pick the product type, and then we can worry about it.
Yep.
Yeah, yeah. That, by the way, just side point. He did marry for love. She's a university
Ah,
professor, and as if you know anything about university professors, that's not a that you're not going to be living off of her labor. Let's just put it that way.
not
So
rich.
what are you going to do? But they're happy, so such is life. Um, Nonetheless, so you're providing a forecasting model, you're providing an
Yep.
asset allocation model, and then you're updating that model monthly, quarterly. What's that look like?
Yeah, I mean, we keep it up to date formally every quarter.
Okay.
The clients do use it in very different ways. I've
Hmm,
always been surprised at how many different ways people can use the same product.
hmm,
Um, so a lot of organizations, they want something that's very formal as part of their investment process, and they want to go through that process either once a year or once a quarter. So you're really giving them a tool which allows them to step through right from the beginning. So what are we looking like in terms of supply? What are we looking like in terms of the background economics? Which are
right,
the key series you need to be interested in? What are the historical trends? And then if we use some econometric equations, which we do, very transparent econometric equations, we can project those forward. And that enables the organization to start thinking about it and start saying, well, okay, that's all very well, but what do we actually believe? What do we actually think is true?
sure. And
And
you're in input to that decision making process like everything else. I mean, and then obviously there are events which no one can predict, like COVID, for example, which just
yep,
you have your theories and then the world intervenes, but that's okay. I mean, that's just the way it works. Um, yeah, and I find, the word econometric, my undergrad's in econ and I did a lot of math. So I did do an econometric senior thesis, so I understand basically what that means. And that's usually the point at which a lot of people sort of get off the bus, so to speak, and say, okay, I'm not really, it's interesting how many people, once you get to higher math, just sort of drop out of the conversation. So
yep.
that's what it is. So client wise, are you finding that when you're talking to a client and you're saying these are the services I provide, are you competing with another firm that provides similar services, or do you find it's just simply a matter of getting them to buy a forecasting product at all? Like, like by the time they come to you, are you still sort of saying, "Let me explain to you why forecasting makes sense"? I guess.
Yeah, yeah, that's a good question. I mean, the market does sort of divide up that, you know, organizations above a certain size, they basically have to have a forecasting process.
Right.
They will be interviewed once a year by the big consulting actuaries, and one of the questions they'll be asked is, "What is your consult in forecasting process?" So they
Sure.
have to have it.
It's part of the conversation. It's just understood. Yeah. Yeah.
And there's basically three reasonably large forecasting houses in the UK. Plus, you've got the big agents, the CBREs, the JLLs. So it's a commodity. Quite frankly, you can buy forecasting. So we try and differentiate ourselves by saying, yes, you can buy forecasting anywhere, but what we allow you to do is basically to build your own forecast. So you're not going to take our view. We will give you a view, but quite frankly, we want you to own your view, because if it's not owned, it always amazed me working in the fund management industry. You could have, there might be half a dozen, maybe even 20 fund managers,
Mm.
and it's amazing how many have their own individual view. So,
Sure. Sure.
so in the same shop, you've got one fund that might be selling retail, another might be buying retail, and there's no homogeneity of a
Uh,
view.
there's a large U.S. money manager that I've done some work with over the years who will remain nameless for obvious reasons. But one of the challenge they had was they had an office in New York and one in Dallas and one in San Francisco, a few different physical offices. Again, we're a big country, and the challenge they had was New York was saying, well, the national inflation rate will be 3. And Dallas was saying it would be 2. And then the people at senior management were like, look, guys, you got to at least agree on what CPI is. Like it's one thing to say Dallas will grow faster, but if we can't even agree on just a national inflation rate, what do we do in senior management? Like this is just crazy. And that was a whole conversation. And then it became how do you build that into the analytical tools they're using to make sure you've centralized certain base assumptions. But yeah, that definitely happens unless like I guess senior management puts their foot down and says, guys, you got to get on the same page. We got to
Yep.
decide as a firm what we're doing here.
Yeah, I mean, they either have a research-led investment process, or they don't. And if they want to have, some sort of process, then they are going to have some sort of formal approach that they're taking. But I very much think what you really want to get at is, okay, well, what is this organization's philosophy? Because, some organizations will be driven, they might say terms like gut feel or something. But even if they say these terms, that still means they do have some beliefs.
Right.
So you want to get at what those beliefs are. So it could be very simple things like offices are cyclical. It's a very simple thing to say offices are cyclical, but it has very profound ramifications for how you basically invest in offices over time. So we can build forecasting models and we can show, why are offices cyclical, and then we can also start saying, well, what might stop that from happening? And right now we've got working from home, so we have to say, well, okay, is there a reason to think that we've somehow completely changed the office rental cycle forever, or
Right.
is this a one-off adjustment? Retail, as you mentioned earlier on, I mean, that was, probably 12 years ago now when we started to see the first impacts. I mean, that has sort of decimated retail rents all across the
Sure.
UK and most of
Well,
Europe.
yeah, online shopping, Amazon. I mean, look, during COVID, I mean, I have a spouse and kids. We're a family of 5, and we survived the entire COVID thing buying everything off Amazon and other online services. So you start to say, well, if you can feed an entire family of 5 through the mail, then why are we going to physical stores? And
Yep.
um, and it's not clear we need to. I mean, which
No.
is a scary statement to make. And I know the retail guys listening to this podcast will say, "What about experiences?" And that's true. There is experiential retail, and if you want to go to a nail salon or get your hair cut, that is still a physical act, but that's a fraction of the retail in America and the world. I mean, and that's the other thing. I mean, I know we're talking about the UK here for the most part, but these are such global issues. I think a lot of times, at least people I've worked with who are in the US, because I've done some international stuff, they sometimes see international stuff as exotic. And I'm like, well, fundamentally, it's the same business. There are only so many ways to build an office building. local regulations vary, but it's still the same issues. You know.
Yep, and it's wonderful when you build models across different markets because you start to see the same relationships. So I mean, I remember doing one big study when we were looking across Europe, and we also looked across the US, and we just said, look, we want to know over the long run, do office rents grow by more than inflation?
Okay.
Or
Okay.
maybe less than inflation.
Sure.
And
Sure.
we studied market after market after market, and we only found a couple of exceptions. And basically, office rents will grow by inflation. They'll be very cyclical,
Hmm.
but they will grow by inflation. So for forecasting, that has very profound implications. For
Right.
one, your forecasting should produce basically a long-term growth forecast around inflation with a cycle.
Sure.
The exceptions are interesting, and the exceptions are where you can actually find some genuine evidence of some sort of supply restriction. So in
Okay.
Europe, we're basically looking at places like the West End of London and places like the historical core of Amsterdam, very, very
Okay.
small areas. So they're the sort of areas that then get very interesting because you say, well, actually, in the long run, these are good places to be. Outside of those areas, we wouldn't really be overly concerned. We would say if you find an office market you think is going to recover, that's as good as anywhere else.
Right, it's all the same, and that's the thing. You can build a real estate empire. You can get a lot. You can get diversification through a lot of product type issues. That doesn't mean you have to go to other cities and other countries, which kind of gets me to my next thing, which is the products you're currently selling are really focused on the UK, correct?
Yep.
Now, why? I mean, obviously you're in the UK, so there's a bias for just doing the UK, but like, have you considered doing other markets or rolling
We
that out as a
we
product suite? Because it's a big
Yeah,
market.
we have forecast in the past the major European markets. It didn't lend itself very well to our process because we were forced to basically rely on what I would call prime data sets. So where you basically get a series from the agents of prime rents and prime yields.
Hmm.
And then you get into something like COVID and you discover that, oh, well, the prime rents are all the same. Well, actually, that's not really very helpful if you are doing what we're doing, which is putting together econometric models.
Mm,
So we sort of realized that approach using this kind of data wasn't really going to work.
right.
So what we did instead with the clients is we started discussing with them, well, look, we want to do forecasting, but what we're really doing is asset allocation. So what we're interested in is how these markets behave and what influences are there on them. And some of the big influences are inflation-linked uplifts. So if you've got markets where you've got inflation-linked uplifts, how do they behave compared to markets which have different leasing structures? So we built more models for them rather than sort of econometric forecasts.
Well, and I need to address that because you just hit on something which is quintessentially of your market, which is the whole concept of the uplift. At least in the U.S., we'll do a 5-year lease, a 10-year lease. We'll fix a growth rate of 3%. It's fixed by contract. It's not flexible. I'm not saying you can't have a flexible one, but that's a rarity. Whereas it seems like in the UK, you guys seem to prefer longer leases, which then have some sort of midterm adjustment, which says, okay, if rents have gone up, then there's as you guys seem to call it, an uplift, which I've only
Yep.
heard it in your context. Um, Out of curiosity, why do you I don't know if you have an opinion on this. Why do you think it is that you guys like long leases with uplifts versus something like an American model, which is just it's a 5-year deal, it grows at 3%, we'll renegotiate it in 5 years.
Well, unfortunately, it's a sort of part of our history. It's a very feudal history that we got. A lot of the landowning was aristocratic. The first leases were actually about 125 years long with no uplifts. And then after a while, people started to realize there was such a thing as inflation. So they
Sure.
introduced rent reviews.
Right.
They went for every 42 years to start with. And
I
then they
need to
realized that
ask,
wasn't a
42 years does seem like a random number.
well, it almost fits into 125, doesn't it? It's
I
not
guess
quite
so.
there, but
Sure. The time. Okay, fine. Times three. Okay, that kind of makes sense in a strange way. Okay, fine. Fine.
and then it came down to 14 years, then it went down to 7 years, then it went down to 5 years. It was always underpinned by the idea that the rent couldn't fall, and that was very much basically about the financial products that they were supporting and also the debt. It makes it much easier to raise debt, particularly for development, if you've got a guaranteed minimum cash flow, even if it's not rising. But the world is changing. The leases have been shortening, as I say, from 125 all the way down now, and they've really come down. 5-10 year leases with breaks. You pretty much get across all the sectors now in the UK.
Right.
Yes, there are rent reviews, but there's break clauses, so it is basically negotiation.
Which to my mindset, I mean, just from a labor standpoint, if a company grows, if a company shrinks, the UK, your labor market is, compared to Europe, relatively flexible. You can fire people as opposed to some European countries where it seems like you need an act of God basically to fire somebody. Um, so it always seemed to me like shorter leases make more sense in a flexible labor market, just because if you're going to grow, you need more space. Just
Yep.
simple, you know.
And
It's
I mean, the whole sort of concept of flexible leasing and flexible working, they're all coming together. So we've obviously had the demise of WeWork, but you know we've had flexible leasing market for well 20, 25, 30 years. Um, and it is always interesting how these markets behave, because a lot of these operating companies, I mean, WeWork are the classic. They take a long lease, a 25-year lease from a landlord, take a lot of incentives out at the beginning, and then in the good times they could earn 2, 3, 4 times the rent by
sure,
leasing flexibly.
sure,
Problem is, in the bad times, that's when they can't get as much rent. That's when their occupancy rate goes down.
right.
They've got a lot of fixed costs, and basically the business model doesn't work. So what we're moving towards now is a much more flexible model, where leases are a lot shorter, and that has big implications for what is the rent? How do you measure the rent? How do you forecast the rent? Because the rent is nowhere near as visible as it once was.
Right. No, it's interesting. It's definitely it's the flex watching Europe in general, to sort of lump you in with the rest of Europe, watching Europe move towards a more flexible space market. I mean, the U.S. has been there for a long time, and talk about history. I mean, it goes to our history. We were not feudal by definition, so we didn't have that basically. So we always were just shorter leases, and that's the way we did stuff. So it's interesting watching it sort of become more generic, more standardized, if you will. Um,
And
Nonetheless,
a lot of trends in Europe. I mean, there is always a bit of a joke in the UK and Europe that you just go to the US, see what they're doing, and 12 months later it'll come to the UK and Europe. Or we are in Europe, of course. Um, but not everything
that's all
does.
other discussion. that's
That
that's all
is.
other. Yeah. No, it's but well, it goes the other way too. You guys, London had serviced offices as a thing way before the US did. You know, the US always had this cultural idea of, well, I'll go fill my own coffee machine and, hire my own janitorial to take out the trash. Whereas the Brits were like, well, you're a highly paid attorney. Why are you fixing the coffee machine? Just have someone else do it. And maybe that's because, frankly, views on class and culture, you guys just liked doing serviced offices more. Maybe that's just a different perspective. But that's something that's been working its way into the US, is people saying, well, I'm a highly paid professional. I should not spend my days worrying about running office space. Let someone else do it. So that's an example of where you guys, I think, did it first, and we're just catching up to it. But yeah, no, I mean, definitely a lot of tech stuff has gone the other way. I mean, that's sort of the way we've evolved. So let me ask a couple other questions, just specific product types. So like, we've talked a lot about asset allocation. I do want to dive into predictions, and I realize predictions are sort of a dangerous thing, but for the next few years, if you were going to pick which product type you think pulls ahead, which product type trails, what's your sense, big picture, about where we're going in terms of retail, office, multifamily in your market, obviously, not global, but just in the UK.
Well, all the sectors are interesting. I mean, just in that order. I mean, retail as basically is trying to find its level. It is bombed out. But the retailers that are going to go bust, they've gone bust. The high street has now changed. The shopping malls, they have changed. There's a bit more destruction to go, but you could sort of see it. So
Right.
we found a level. It used to be that retail was, low yield, high growth. Well, now it is high yield, no growth. So
Right.
it's a different product. You've got different occupiers. So, gone are your sort of big multiple retailers, and now you've got much more of your nail bars and your pet shops and you know, goodness only knows what's going to be next. So it's sort of found a level,
Right.
um, and it's all about price. And one of the things we do with asset allocation is we say, look, we don't really mind what sector we're in. We just want to know if the price is going to deliver an attractive return or not. And that's what we'll do on retail. We think probably the yields got to an attractive level.
Right. And if you
Offices,
buy a high yielding product with not great growth, is still a high yielding product. So that's not
yeah,
bad. Office?
yeah. I mean, everyone always likes a product that grows, but sometimes, well, we'll just take the yield and
Sure.
don't worry about the growth.
Could be worse.
Offices is fascinating because we're obviously seeing an awful lot of value destruction because office buildings that are older. Once upon a time, you build an office building for 25 years, you'd let it to a really good covenant, and then at the end of that time, they'd move on, they'd go somewhere else, and you'd multi-let it.
Right.
That's not happening now because we've got all of the sustainability legislation, and really the length of office life has just been slashed. So a huge amount of value destruction. Equally, there's been a marked reduction in demand because of working from home and flexible working. But the great thing about offices is they do depreciate and they do disappear, and you are basically therefore left with a new office market. And in this office market, there aren't really enough really well located, high quality buildings to meet any increase in demand. So at the moment, there isn't really much of an increase in demand. But what we want to see in an office market is where there's the conditions in place, i.e., not much crane activity,
Mm.
so that if there is an upswing in the economy, such as the US has had, which we unfortunately haven't, rents will suddenly start going up. So the high vacancy rates are concerning if you own that kind of stock. But what hopefully investors are sort of positioning themselves for is basically an upside shock. And we could see office rents, spike higher 30-40%, which they've done in the past many, many times. We could see that happening again.
Well, and your point about office stock is interesting in that, office stock is broad. Like there's a lot of older depreciated stuff that just frankly does not compete with a newer asset. And whether or not it's sustainability regulation in terms of law or just preference, I mean, it seems a lot of firms are now saying, look, regardless of the regulations, we're concerned.
Exactly.
We want to do this even if the government doesn't tell us to do it, which I think is a major cultural shift. And we've seen it in the U.S. I mean, we are definitely a divided country politically, so it's definitely more of an issue in some markets than in others, but it's still part of the conversation. But yeah, there's a lot of obsolete office product globally, and the obsolete stuff, I don't think anyone has any idea what the heck they're going to do with. That's
Nope.
interesting stuff. Um,
But I've worked in cities for many years, and if you look around cities, you will always find, office buildings that once upon a time were lovely and new and look pretty decrepit. And
sure,
it's a terrible process of destruction, but that's the office market.
that's life, and they could be teardowns, and that's okay if they're well located. And then finally, multifamily apartments. What's your sense on
Yeah.
multifamily?
Well, we're pivoting a little bit into multifamily. The residential sector in the UK is just minute compared to most mainland European countries and indeed the US. So, if most countries are at 25-30% of investor portfolios, we're down at 5-6%. Um, Although with a little bit of a history, when I first got a job at a fund management house, they were actually selling their multifamily,
Hmm.
and they were selling it because there had been rent controls. So in the 1960s, they decided, right, we'll get out of multifamily. So it took them 20 years to dispose of the last building. That same organisation, Legal and General, is now at the forefront in the UK. So we're going to see this sector grow massively. I just can't can't see it going any other way. So we find it very interesting to be involved. Um, what
Eh,
exactly the stock becomes is then interesting because you've got the multifamily, you've got the single family, you've got the senior living, you've got the co-living.
right. There are
That's the bit that's
a lot of different ways to put a roof over your head. Yeah, yeah. It's a much broader market, and we have the same conversations here. I mean, there's rental product, there's for sale product. What do you do about the fact that people are putting off marriage and kids longer and longer? Does that mean there's more need for rentals? Is it a different quality of rental? Because now they're affluent, they're renters by choice, not renters because of poverty, and that's a different mix. Um, no, it's definitely your point about the UK market. I find as an outsider fascinating in that yeah, you're a nation of homeowners. You don't have your rental market is very small,
yeah.
which is interesting. I mean, I it's not my mindset. I mean, I live in a
But
own a house, but
it's a good illustration of how important regulation can be because bad regulation in the UK basically meant we didn't have a decent institutional rental market.
right,
And hopefully that'll be put right. But you never know with the government, and it's always the caveat. Writing a research report for investing in residential, it almost writes itself, and then you get to the risks, and you basically have to write all the regulatory risks, and you just think, that
sure.
that's the issue.
Then there's a
Just
change of government and the rules change. And then, yeah. No, and that's well put is that multifamily, the rules change a lot more than they do on other product types because homeowners and renters vote. And as a result, they have opinions. Whereas
yep,
your nail salon doesn't.
no,
It's the business doesn't get to vote, the people do. No, it's interesting stuff. It's interesting stuff. Well, look, it's fascinating to talk about the forecasting model. I guess my last question would be, and it's just a client question more. So, you've got these clients, they're like what kind of clients what do you think of as your ideal client? Like what are you looking for in the client relationship? Like you're a service provider, I get that. But what are you looking from them in terms of feedback, communication? Like what's a good relationship for you?
yeah. I mean, the ideal client is where you've got a fund management house which has got a research department, but there might only be one person or maybe two people. So it's impossible for them to do it all themselves. They have to outsource. So
Right.
they're the ideal client. Um, there's a big issue in the UK in that we have a lot of private equity, a lot of it North American based,
Hmm.
investing across Europe.
Yep.
So actually, those type of organizations are really struggling at the moment, and a lot of the money is going to these, vast PE shops. And of course, what they're doing is asset allocation or forecasting very much at the top down level. They're really not interested in the returns on individual buildings. They're making calls on huge portfolios, whole sectors.
Sure.
So
Paris
the whole
versus
like
London, office versus retail. Sure.
so the whole emphasis has just changed over the last 10 years, which I mean I find fascinating. I mean I love these kind of changes in the industry. And you only get that kind of perception when you've actually been around for a while and you see, wow, things can change massively over very short periods of time.
Hmm.
So the ideal client is actually, a client that's actually under pressure, but that's what we like. Um, what's also interesting is where clients are starting. I know in the US it's far more likely that you've got places that are investing in debt and equity at the same time.
Mm.
In the UK, that's really relatively new.
Hmm.
And I think it's very interesting when you start saying, well, okay, I could lend on retail or I could do an equity on retail. Well, how do I make that decision? What, what do I do? How,
Where in the
how do I
capital
work
stack
out?
do I want to be? Yeah, it's
Yeah.
a risk reward conversation. Yeah. Yeah, 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 yeah. No, that's true. I mean, definitely there's been a real rise in non-bank lenders. I mean, a lot of at least in the US, a lot of traditional banks are capital constrained because of everything that happened. So you've got a lot of entities that are not banks who basically will say, well, I used to take an equity position, but for the right rate, I'll be a debt provider. Sure. Better security, good yield, you know, it could be worse. Could be worse. Um, Interesting. Well, look, this has been very illuminating. It's always good to talk about another market and also about the the life and times of an economic forecaster, because I think it's something a lot of people don't really understand. I think a lot of people, when they think about economic forecasts, they don't think of it as an industry level. They think about it as sort of what they hear on the TV about the economy in general. Um, so good. Well, look, I'm really glad we had the chance to go through these things, and thanks again for your time, Malcolm. Much
Great to
appreciated.
chat. Brilliant.
Excellent.
Thank you very much.
Thank you.
Cheers, Josh.